Good evening, everyone. My name is Prajakta. I am from the product and training team at NGEN Markets. I'll be conducting today's webinar for you. So our today's webinar topic will revolve around three key areas. They being performance analysis of portfolios of clients, existing as well as prospectives. Secondly, we will look at how we can really analyze rolling returns, drawdown analysis, scenario analysis with respect to different customizable scenarios. Third, we will look how we can really generate customizable reports from our analysis, which will have multiple analysis parameters that we would have just seen. And then lastly, we will throw the forum open for a Q&A session, wherein you can get your answer, wherein you can get your questions answered by our team. For that, let's just start the webinar. I am on the NGEN Markets platform. In the clients section, what you can see is all of your existing clients will be listed over here, which are linked to your ARNs. Let's just load in a specific client portfolio. To load in a specific client portfolio, all you need to do is...
Can you put everybody on mute?
For that, what you can do is just load in a specific client's portfolio. Let's take in, for example, Rakesh Kumar's portfolio. Just click on that and the portfolio will get loaded. Right in the first screen, you will have a bird's eye view of the components of his portfolio. So what does his asset allocation look like? What is the SEBI classification of his component funds and the list of all the funds that he is currently invested in? It will take the current values as on a specific date, right? So these are the positions as on a specific date. Later, if you want to run analytics on it, which will be a major part of our discussion today, you just have to click on run analytics. So when you do that, a detailed analytics of the entire client's portfolio will really be run. You can perform backtesting, historical backtesting of his portfolio performance with respect to a specific index. And these are not going to be just static indices. You could just go ahead and choose in a specific index of your choice, which you think is relevant for your client's portfolio. For that, you can just change the benchmarks from here. So currently, as we saw in the bird's eye view section of the portfolio, his portfolio was pretty diversified, right? So he was invested in equity as well as debt. That is the reason the auto benchmarking has really happened to an extent of 50% Nifty TRI and 50% of CISL bond index. So you could just go ahead and change the weightages accordingly. So we have given some custom benchmarkings so that are visible right here on the right hand corner in the box. You could just choose in whichever you think is the appropriate one. However, an auto benchmarking will happen, which will be according to the portfolio that you have really chosen to run, right? So currently it was 50% Nifty TRI and 50% CISL bond index because his portfolio was pretty diversified, right? Invested in equity and debt both. What you can also do is create your own custom indices. For that, you just have to click on custom benchmarks. Just click here to add and manage custom benchmarks. And then you can just go ahead and include whichever indices you would really like to include in the benchmark sections. Let's say, let's go ahead and add in a couple of indexes. Let's add in Nifty TRI. Just click on add index and given a specific weightage that you would really like to give this to this specific index. I've given a 40% weightage to Nifty TRI. Let's just go ahead and add in a CISL T-bill index. Just choose the index you would like to add. Just click on add index and allocate accordingly. Let's say 40%. And then you would like to add, let's say, a mid-cap index. So a Nifty mid-cap 50, just do that. Just click on add and put in the weightage accordingly. Just name this customized benchmark as, let's take, for example, custom score 1. and that's it. You just have to save the custom index and the index just gets saved. You could use this index for later analysis of other portfolios. It will be saved in this specific weightages. So you do not have to repeat this exercise again and again. You can see that our index has just gotten saved over here, right? So this is how dynamically you can really choose whichever benchmark you would like to look your portfolio performance against. Let's now come to detailed analytics of the existing portfolio, right? So the first tab is the asset allocations tab. Here you can really see the exposures in detail from the specific stocks and the underlying schemes. Let's say, for example, we were to see how is this portfolio getting exposed to ICICI Bank. So you just have to click on I, and then this is the underlying fund through which ICICI Bank certificate of deposit is basically exposed to this portfolio, right? Let's just click on equity. And when I click on equity, you can see that this specific portfolio is exposed to Sun Pharma through these specific mutual funds. If there is a direct holding in the stock, you will have another row here which will say direct holdings, right? So currently this portfolio is being exposed to this stock per se from these specific mutual funds. That is how the exposure is coming. This is how you can really see the overview of the asset allocation and all the asset allocations accordingly for all the specific components. Let's now come to the concentration analysis. Here, what you can really see is what is the contribution of the top 3 components in the portfolio to the total AUM of the portfolio. So highly concentrated between the top 3, here the percentage ratings is 33%. And from the top 20 holdings, the portfolio is concentrated to an extent of 50, close to 56%. So this is exactly what this concentration analysis really tells us. We also have details like AMC exposure, and you will really see which specific AMC and their accordingly exposures in the client portfolio, right? And if you want to really see the components of the specific mutual AMCs, you just have to click on the AMC here, and then you will have the detailed schemes. Just right here. Let's say now you want to look at specific equity sectors. So you just have to click on equity sectors, and you will have a detailed asset class wise allocation of the equity sectors. Just right here. So when you just click on equity sectors, different sector wise allocations will be visible to you right here. Again, we have given a Excel download button over here. You can just click on this and download all of these sectoral exposures for your record in an Excel sheet. Let's now come to performance analysis. Here, what you can really do is backtesting of the entire portfolio performance vis-a-vis a specific index, specific benchmark index, right? So currently, it's chosen as reference index 6, which is 50% Nifty TRI and 50% CISL bond index, which I already explained in the first part of the webinar today. So what you can really see is the blue line indicates the portfolio performance and the black line is the benchmark performance. In this specific period, you can see that the portfolio has been able to outperform the index consistently. Let's now look at some key parameters like Sharpe's ratio and historical VAR. So for Sharpe's ratio is an indicator that how are the risk-adjusted returns of the entire portfolio on a whole vis-a-vis the benchmark. So what we really mean by asset over here is the portfolio under consideration. As we can see, the Sharpe's ratio of the portfolio is 0.43, and that of the benchmark in this same specific period is 0.32. That means the portfolio has been able to outperform the specific benchmark that we have really chosen. Let's now understand what historical VAR at a 95% confidence interval will really signify. So what this really signifies is the downside protection of the portfolio. So what we can say is with a 95% confidence interval, there is only 5% likelihood or a probability that this specific portfolio will give returns which are below this. In other words, we can say that with 95% confidence, I can say that this portfolio has never given returns which are lesser than 11.48. So there's a downside risk protection close to 11.5%, vis-a-vis the benchmark, which is 13.05%. So in this parameter, what we can really say is the specific portfolio has outperformed the benchmark with respect to this specific parameter. This is a pretty much statistical indicator. The relevant levels will be 90%, 95%, and 99%. What we can do is, if you want to look at a 99% bar, just edit up this level and just click outside and you can really see. So even with a 99% confidence interval, we can say that 99% of the times this specific portfolio will never generate returns which are less than negative 20.88. What I would like to really highlight over here is this specific parameter is only indicative of the downside risk protection and not the upside potential, right? So this does not speak anything about the upside potential. It can go up to any percentage, 15, 20, whatever. This just says a downside risk protection, which is really relevant when you are really telling your client that your portfolio will have a downside risk protection of 20%. You will never have returns from your portfolio which are negative than this. So this is a very crucial parameter that way. Down here, when you scroll, what we really have is performance of the portfolio vis-a-vis the index in terms of alpha, the excess return that the portfolio has generated over the benchmark. So what this really is the alpha which the portfolio has generated. We can see that there's an alpha of 25.57% and a tracking error of 3.89. So what tracking error really signifies is how closely the portfolio is able to track the specific benchmark that we have chosen. So this benchmark is a weighted average of two specific indices, one being Nifty TRI and the other being CISL bond index. So there's a tracking error of 3.89%. So lower the tracking error, the better it is in general terms. So we can see that with a tracking error of 3.89% and an excess alpha of 25.57%, the portfolio is generating an information ratio of 0.50. So what information ratio is a collation of two parameters. It takes into consideration the alpha and the tracking error. You can really use information ratio as a parameter to really look at the performance of the portfolio. So ideally, higher the alpha and lower the tracking error, better will be the information ratio. So you have a better alpha, you have a positive alpha, and decent tracking error, decently low tracking error. You will have a good information ratio, positive information ratio. However, if your alpha is negative, then your information ratio will also be negative. So it's a direct relation between alpha and information ratio. So you can really use this parameter to analyze portfolios of your clients, and not just existing clients, but also prospectives, right? Let's now come to the monthly chart here. What you can really see is the statistic is an indicator of month-on-month performance of the entire portfolio taken together between a specific time period. So currently it's being taken as 2009. What you can do is just scroll up and change the start date. For a use case, let's take it 5 years ago. So when we do that, our start date is really changed to 16th of Jan 2018, and then let's see how month-on-month performance of the portfolio was from this specific period. So from 2018 till today. So you can see that these were the month-on-month performances that were really reported by the portfolio. Alongside that is the yearly chart. So as we've chosen a 5-year period, what we can see is on the basis of calendar years. So 2019, 2020, 21, and 22, the returns that were really reported by the portfolio as a whole. This down here are monthly statistics. What will this really do is it will take into consideration the number of months. So total number of months under consideration with respect to our period that we have really chosen as 61, and among them upper months, as in the portfolio generating positive returns up. were 39 months and down months were 22. So the percentages, relevant percentages being 63% of up months and 36% of down months. Additionally, what we also have is, let's just go to contribution analysis, and then we will really be able to see how the each components of this specific portfolio have contributed to the overall portfolio return. So this is a very important decision parameter so that you can really advise the client accordingly whether to increase a specific weightage to a specific scheme in the in the portfolio, or to just exit positions, right? So this is a key decision making parameter. So as we can see, let's take in a specific start date. Let's take in from 2019. We will see the contributions of the component schemes in the portfolio. Let's choose an end date and just click on run. So when you do that, you can see that this specific fund, which is IDFC bond fund short-term plan, has contributed to an extent of 26.11% to the overall portfolio returns, right? And the lowest contributor to the overall portfolio returns is Kotak Equity Opportunities Fund. Let's now just change in the start dates. Let's take it from 2020, let's say mid of 2020, and see how the contribution analysis undergoes a rapid change. So we can see that HDFC Mid Cap Opportunities Fund during this period has contributed a highest to the overall portfolio returns. So it is that dynamic. You could just change in the start and end dates, and you could really see between these specific time frames which were the top contributors to the overall portfolio returns, right? Let us now go ahead and look at correlation analysis. So the correlation analysis here is nothing but the uh, coordinated movements or the relation analysis between the component funds of the portfolio. So let's say, for example, we want to look at correlation between HDFC Midcap Opportunities Fund, which was, by the way, the top contributor to the overall portfolio returns during this period, right? So let's see what is the correlation of HDFC Midcap Opportunities Fund with, let's say, a debt-oriented fund, which was IDFC bond fund, which, as you remember, was the top contributor for a different period, right? So we can see that there's a pretty low correlation, which is 0.13, which is evident enough because HDFC Midcap Opportunities Fund being an equity-oriented fund and IDFC bond fund being a debt-oriented fund. So it's a pretty low correlation, right? So it's highly likely that when HDFC Midcap Opportunities Fund will do well, will be performing better, IDFC bond fund will, in high likelihood, be giving some not so pleasant returns. Conversely, what you can see is there's a very high correlation of close to 0.92 between HDFC Midcap Opportunities Fund and Kotak Equity Opportunities Fund. So it is very highly likely that when HDFC Midcap Opportunities Fund is doing well, even Kotak Equity Opportunities Fund would do well. Let's just go back to the contribution analysis and let's see what was the contribution during the same time of Kotak Equity Opportunities. Let's just go back and you can see that Kotak Equity Opportunities Fund, in spite of having that high correlation, has given only 3.16% contribution to the overall portfolio return. That's because you can see that the allocation to Kotak fund is the lowest here. So the correlation was very high. So what you can really advise the client here is, if you would have increased the weightage to Kotak Equity Opportunities, as the correlation between HDFC and Kotak was very high, if the weightage would have been decent enough, let's say, for example, more than 5% your portfolio returns would have substantially increased, right? So this is a very good conclusion what we can derive from jointly from this contribution analysis and correlations analysis. So none of these factors are to be looked at independently, but jointly taken together. So take contribution analysis and look at which is the highest contributor, and then just go ahead and look at correlation analysis, and then just go ahead and accordingly recommend the client to really increase or decrease the portfolio weightage of that specific fund. Let us now come to rolling analysis. What rolling analysis will really do is how it will show in the average returns that were really generated by this portfolio in different rolling windows. So these are highly customizable and editable windows. These are not hard-coded numbers. You could just go ahead and change the windows. So currently 260 signifies a 1-year rolling period, 520 is 2-year rolling, and 780 is 3-year rolling. So we have taken an equivalent working days equivalent. So working days of 260 in a year, that's why we've taken it as 260. So you just have to click on run, and a rolling return analysis will really get run. So what this really says is, in absolute return terms, in 1-year rolling window, average return of 9.74% was generated by this client portfolio. In a 2-year rolling period, that is in 2-year window, a 22, close to 23% average returns were generated by the specific portfolio, wherein you can see that volatility in the 2-year window has also substantially increased vis-a-vis 1-year window, right? So 1-year window volatility was only 9.96%. That's just close to 10%. However, in the 2-year rolling, the volatility increased by close to 2%, and the returns, average returns, really increased by a whooping 12%. So the 12% increase in returns by just a 3% increase in volatility, right? And as we move ahead to a 3-year rolling analysis, what we can see that the average return that was really generated on an absolute basis, of course. If you would like to really look at analyzed basis, just click on analyzed, and the analyzed basis return will really be visible. Down here is the rolling returns distribution analysis. This again is a very important parameter that you can really incorporate while taking a call with respect to client's investment objective. Let's say a client comes to you and says that I want to build a portfolio, or just analyze my portfolio and tell me if my portfolio is giving me returns, or what percentage of times it is giving me returns between, let's say, 5% and 25%. So I want to look at the returns that were generated by my portfolio in this specific return range. So for that, you just have to put in 5% here, the specific range that was requested by the client, to 25% here, and you can say that 47.23% of the times your portfolio has been giving you returns between your specific required return range. So this is very crucial. That way you can really just put in a series, let's say 5 to 10, 10 to 15, and then 15 to 25. All of this is highly editable, and you can really tell the client the specific statistic, the frequency of the portfolio returns being in this specific range, right? So this is what is the utility of this rolling return distribution. Let's now come to another crucial part, which is the drawdown analysis. In drawdown analysis, you can really just scroll down and look at the tabulated manner, tabulated way of top 10 drawdowns of your portfolio. So what this really signifies is the strength of the portfolio to recover from a drawdown. So any client portfolio is going to be subject to a downside or a downturn at some point of time. So no client portfolio is ever going to be immune to the market downfall, right? So every time, at some point of time at least, there is going to be losses. So what this really is an indicator is, how much days does the portfolio take to recover from a specific loss? So losses are inevitable, but you should know that how um, uh, quickly your client portfolio is able to recover from that specific loss, because that becomes a key decision making parameter. As you can see, let's take in this first row. What this really says is there has been a loss of the magnitude of close to 20%, so 19.89% between this period. So starting from 7th February 2020, there has been a loss of 19.89%, and the loss, the downturn basically ended on 23rd of March 2020, and the days the portfolio took to recover and go back to the start price was 103. So what we really mean by start price over here is the weighted average price of each of the fund component funds NAVs, right? So these the weighted averages will be according to the allocations, and accordingly we have come at a start price. So what we can see is historically the portfolio has taken nothing beyond 130 days, never. In the last 10, these are the top 10 drawdowns, and has never taken more than 120, 125 odd days, right, to really recover. So that means the strength of the portfolio is pretty good. It really recovers in less than 6 months, is what, in less than 4 months practically, every time it has a drawdown. So this is a very crucial parameter that you could really uh, tell your client. What is the last topic for our discussion today is the scenario analysis in portfolio analysis. So in these scenario analysis, what we have really done is created some specific customized scenarios for you, and you could just click on one of them. Let's take in, for example, lockdown one. I've just clicked on lockdown one as a scenario, and we can see that the start price and end price is over here, and the excess return that was really generated by the portfolio vis-a-vis the index during this specific time is right here. So as you can see, the blue line is the client's portfolio return, and the black line is the benchmark. So you can see that portfolio, even during such volatile times as lockdown one, has been able to beat the specific benchmark, right? And these are not very hard coded ones. You can really customize these specific scenarios as per your requirement. Let's say you want to include a specific scenario wherein you would like to upcoming budget sessions, right? So 1st of February onwards, you'll start looking at the effects on Indian market specifically from the last week of Jan, and then those effects will go on until mid of February. So you could just create the scenario as a budget 2023, put in the start date as, let's say, 25th or 26th of January, and then end date as 15th of February, and then just save this custom scenario and look at how your portfolio performed during that specific time vis-a-vis the benchmark that you've really chosen. This is how you can really show this analysis to the client. Let us now come to the last part of our webinar, which is generating customizable reports. This again is a very crucial part that our platform really offers. We offer multiple customizations in the form of a PPT report. So a standard PDF is anytime available. So you just have to just click on a PDF, and a PDF report will really get downloaded, which will show in these key parameters of analysis of a portfolio that we just discussed in the form of a PDF. It will be a 4-pager PDF, and you could just send it across to your client to really show what were the key analysis parameters of his portfolio. So just have to download it. And again, I would like to mention that a highlight of all our PDF reports is that they are going to be co-branded. So you'll have your company name and logo over here. And this is the specific PDF report that will really get downloaded. It will have the key parameters that we just discussed. So Sharps ratio, 95% VAR, excess alpha, tracking error, information ratio, yearly chart, and even drawdowns. So we just discussed drawdowns in detail, right? So this specific report will have drawdown analysis as well. So this is the PDF report of your client. What you can also do is create a PowerPoint. So this a highlight of this PowerPoint is that it will have a facility to include amount in it. So as we can see, the current client's AUM is 1.14 CR. That is why it has just gotten populated over here. And then when I just click on create PPT, a customized PPT will get created, which will have the AUM of the client, which is under consideration. So it will not be just some random percentages, but specifically to the client to the extent of the AUM that he currently holds. So that is generally better to understand in rupee terms, right? Instead of just some percentages, the client may find it a little difficult, but when it is in terms of amount, in rupees, that will really be helpful for the client to really understand how he holds in specific mutual fund schemes. So once the PPT gets loaded, I will just show it to you how different slides, and again, it being a PPT, it is highly customizable. You can just add in a slide. You could just delete a slide if you do not want to include that in your client presentation. So that way it's pretty editable that way. So these are the customization and customizable reports that you can really generate from our platform. So that's how the PowerPoint will really look like. Once it gets loaded, I will just show it to you how a entire capital of the chosen client will really be there. Additionally, meanwhile the PPT opens, what I would like to say is, in addition to these two specific reports, we also have some things like client link and share link. From that, what you can do is just click on that and generate a mobile link for the client to really access his analytics that we just saw on the screen on his mobile phone. So you can really use that feature and send it across to the client. What you can also do is click on position analysis. So what this will really do is a position, a detailed analysis. Positions, all the positions that the client really holds will get downloaded in the form of a PDF report, and you could really see that.
Your screen is stuck, or is it visible to me like that?
Okay, I will just check it, ma'am.
Yeah, Prajakta, if you could just stop sharing and just restart your sharing.
Yes, sir.
Yeah, you can go ahead
Hello.
and go ahead and show the client links and share links.
Yes, yes, surely. I will just go ahead and show you how client link really looks like. So when you click on client link, this is how the window really opens. You just have to put in the client's mobile number and click on create client link, and a mobile based link will really get created. So it will be right here, and you can really perform you can really show it to your client. This is how the mobile link will really look like. So pretty much crisp, right? You could just send this across to the client, and then he just can access it from his mobile phone. And this is how the view will be. This pretty much brings us towards an end of the topic related webinar discussion. We will now throw the forum open for Q&A, and you can directly unmute yourself or just put in your query in the chat box, and our team will answer it.
So I think we'll go with the three questions of the chat first. The first one, and I believe the second one as well, is basically historical VAR and implied VAR. So Prajakta, if you could just go to the performance tab and just show us the VAR that you've got. Yeah. So in both cases, VAR is obviously it, as we've explained here with the question mark, is that it basically shows you, the amount of loss, the amount of annual loss that you can have, and the percentage chances of that happening. So this obviously is saying 5% of the time you could experience a loss almost 12%. Now, when it comes to value at risk, VAR or value at risk, there are various different methods of calculations. Two of the most common methods are historical and implied, and there are quite a few others also. But we only show you two. So the historical one is calculated by looking at the returns of this portfolio, which is the blue line that you see on the chart, right? So looking at the daily returns, and from there looking at the worst fifth percentile. So it gives you a probabilistic answer of where, what the chances are of what kind of loss you have a chance, 5% chance of having. For the implied, it's done slightly differently. Instead of looking at daily returns, we actually look at daily standard deviation or daily volatility. Using that, we implied back from the normal distribution. So basically, it looks at how variable the price was. Now, generally speaking, these two numbers won't be that different. You can see one is minus 11.88, the other one is minus 13. So there will be slight differences, but generally speaking, both of them are there for you to use. We also had another question saying, can you explain rolling analysis again? So let's go to the rolling tab. So as Prajakta showed you, I mean, these three windows, 265, 27, 80. Keep in mind, these are working days, not actual days. Now, what we're really doing here is we are going through time. And Prajakta, let's take your mouse over the blue line some point and just stop there. Yeah. Okay, so let's look at that point. So that says 15th March 2021, 260-day rolling. So this means this 28.72 that you see on this chart, this is the 260-day return on 15th of March 2021. On that day, the previous 260 days, this was the return. And then what we do is we move one day ahead. And it'll be hard to move one day ahead on the chart, but just move some random day. Yeah, fine. So we keep moving ahead. On 24th March, the 260-day return was 34.9, and on we go. So we keep calculating the previous 260-day returns on a daily basis through time. And that's the chart that you see here. And then on the right hand side, when you look at the table, when it says the average column for average row, this is actually the average of the blue line on the left. The blue line is obviously referring to the 260, right? So 9.74 is the average 260-day return. And it's quite useful to actually make a factual statement. You can say, for example, that this portfolio backtest or a fund or whatever you're looking at, on average, this particular security has produced 9.74% of return considering all 260-day periods or all 1 year periods. So that can be your expectation of a 1 year return for this fund or portfolio, which is quite a useful thing to have, right? And even more, you can see what was the best 260-day period. You can see 37.81. Okay, so that's the highest 1 year return. If somebody is looking for more than that, you should tell them, well, look, more than that has never happened in the past. Or if somebody is worried about downside, you can say that worst it's ever been for a 1 year period is minus 14, right? It's never been worse than that. And you can see the low point of the blue graph on the chart there. And then similarly, same thing for 520 and same thing for 780. You can obviously change these numbers and click on the run button. And so, yeah, so hopefully that gives you a good sense of rolling analysis. We won't go into further details of distribution, but this basically analyzes the results that are on top.
I understood this. You are telling on a yearly basis. This is on a portfolio basis, but we can check this on our respective fund also, right?
Absolutely. So, Prajakta, just click on something. Yeah. Click on a fund, and as you'll see, it'll open up in a new tab. Yeah, there it is. And in that, you simply have to go to the rolling tab for this particular fund that's just loading.
That you were talking about a portfolio you were speaking about, that means that in a year the portfolio will not go lesser than minus 14%. That is what you indicate here.
That's right. And that's right. And I would just maybe slightly change that statement by saying that I wouldn't say it won't go. I would say it has never gone before below that.
So
Yeah. So there's another question saying, what is mutual fund foreign equity represented in asset allocation? So if you load any mutual fund, let's search for funds on the top. I'm not sure which kind of funds will have some foreign equity. But if you, okay, just go back to Aditya Birla Sun Life FlexiCap. So the tab that you have open here, and go to asset allocation overview. So you will see foreign equity here if you have any funds that have, let's say, access to, Alphabet or Apple or whatever, you will see a bucket here called foreign equity stocks. There's another question saying, can you explain correlation again? So Prajakta, let's go back to portfolio and the correlation tab. Okay, so this basically, this is quite useful and very important, I would say. This is a portfolio of how many, I think 8 or 9, 8 funds. So we want to see how good or bad our diversification is. So what we're doing is we're looking at the correlation of these 8 funds to each other. So what that means is if we stop at one of these, this is HDFC Midcap and ICICI Potential Value Discovery. So this 0.86 shows you that this is the correlation between these two funds' NAVs. So, and it's not low. I mean, it's not very, very high, but it's not low either. And this shows that these two are moving quite closely together. And that that should give you a sign that that's probably not a good idea, at least as far as diversification is concerned, and you should probably take one out and keep the other. Now, this is calculated by us on the basis of daily returns, which is extremely important. Otherwise, correlation won't really show. Correlation can obviously take the highest value of 1.0 and the lowest value of minus 1.0. 1.0 meaning they will be exactly the same. As you can see, that's this, because this is a matrix. This is HDFC versus HDFC, so it's the correlation is perfect 1.0. If it was a negative, then it would be -1, and as you can see here, the numbers are quite close to 1 in most cases. There's another question saying, please explain the creation of custom indices. So Prajakta, let's, okay, so firstly, whenever you load any fund, stock, anything, on the right hand side, you will see the change benchmark, run analytics. You'll see the change benchmark box here. In that box, the first tab is custom, and this is where you can make your own index. And the way you can make your own index is you can combine the existing indices that we have with any given weights, effectively a portfolio of indices basically. So Prajakta, let's just do just add Nifty TRI. So just add index on the right hand side, and then choose another one from the list. Yeah, fine. Choose anything, doesn't matter, and add. And add one more. Right. So for example, just so you know, you can see, and you can just do 50, 25, 25, right? So whatever these are, so we've just picked 3 benchmark indices, and we've put the weight so that they all add up to 100, right? And now we can give it a name and click on the save button. So you have to be patient. It can take up to 20-30 seconds. So because it's uploading data. So what it's doing is creating a full historical index. You can see the start date in the background. It's saying 1st Jan 2004. So you will have an index which is now created using those 3 indices with those weightages that you put in. And the key part is that as time moves ahead, we will update it on a daily basis for you in the background. So that's the one that Prajakta just created. So you can see, you can do this on the fly. It didn't really take that long. And once you do it, there you go. She's got a portfolio, and she's actually benchmarking it with a benchmark that she just created right now. And she won't have to bother to update it, because our system will update it on a daily basis as the constituent indices get updated. And please note that once you create the index, it will be available for any fund indexes. It's not like it's available just for this portfolio.
Prajakta, I also had a question that can now we upload CDSL NSDL statement or not with NGEN?
Yeah, CDSL and NSDL statements are available at the statement analyzer. Prajakta, just go back and show the link again in case it went too fast. Yeah, so that's where the link is. Okay, let's go back to it now. So here, again, please note that you can only upload NSDL, CDSL, and CAM statements. and if you edit to the file, then it won't work. You put the password and choose the file. It will identify the file. Once it's done that, it will let you up. Most people, this has been working without any issues.
So there is some another kind of, you said statement is required with what the client has. Last time when I asked and I tried it, didn't happen. So that's the reason I've been asking you this now.
Is it? Did you send a Motilal Oswal statement? Is that the one?
No, not that one.
Are you sure that it was a CDSL, NSDL, or a CAMS Carvey statement?
Yes. So camps mein there was a statement which was with detailed
Yes.
statement, and CDSL and NSDL, that is a normal statement which comes like 1 or 2 month
Okay.
gap basis.
Okay, so earlier we were unable to read the CAMS detail statement. Now we can. So if you upload it, it will work. So I suggest that you just try it once. If it's not working, please just write to support@engineresearch.com. We'll look at it immediately.
Okay, so it is there under statement analyzer. I can do that now.
Absolutely. The old method that we had, that one could not read CAMS details. It could only read the summary. But this one can read detail now.
So with it will come with all the transaction and everything. It will this thing.
Well,
Analyze.
it will only analyze latest holdings. We don't calculate PNL. So it will show up like this. It will show up like this, and you'll be able to see everything that is inside, but not transactions, because we don't calculate PNL.
So it won't be able to fetch the XIRR, but then it will give us the overall picture like that.
Correct. Correct. That's right.
Okay.
Are there any more questions? The question saying CAMS detail, we can see the values after uploading. Yes, definitely. Not just the values, you can, once you uploaded it, projector, let's just show them, yeah, what you just did basically. So you can, once you load it in the statement analyzer, you can just upload the portfolio in here and save it. You can also, by the way, add it to the manual data section. So if you cancel this and you go to the client section, if you go, yeah, so here you can actually add a new client just by clicking the plus button. So I think Project has already done that. So, yeah. If there are any other questions, please just unmute and let us know, or just type in the chat, please.
Nothing from me. I'll just check this. I'll upload this. If I have error, I'll just send a mail.
Thank you. Thank you. There's a question about consistency ratio. So I'll be honest, I haven't heard of this one before. But if you tell us the methodology, we are more than happy to input the calculations here. I personally have not used consistency ratio before. So yes, if you can send us details through, we are more than happy to put that into the platform. No problem. I'll just put the email address here. If there are any other questions, please let us know.
Sir, can you repeat again the client, how to share the customer mobile link?
Of course, Projecta, can you just start that? Yeah, so this is obviously only for use to send a client who is going to look at it on the mobile. So we've given you a text message kind of ability, you don't necessarily have to use it. You can send it to them on WhatsApp also if you want. But firstly, the thing is, before you generate the link, you have to check all these details. So you'll have to generate a pin. You can click on the top buttons, it will generate a random pin, or you can type it in yourself if you want to put 1, 2, 3, 4 or something. Yeah, and then start date. Now let's just go through the options. So start date here, this refers to the start date for the analysis. So Prajakta, just click the analytics tab in the phone view. So here you can see this period, you can see in the, it's run a back test. And if you scroll down, Prajakta will show them that it's got everything here, asset benchmark, most simplistic view than the proper analytics page, but more than enough for a phone. Here, so again, if you, whatever start date you set, that is what it will load when the client looks at it, right? The next option is the benchmark. So here, obviously a benchmark is loading. So which benchmark should load with this analysis? So you can choose that also, and that will be saved. And finally, this percentage of AUM, will tell you what that is. Prajakta, if you go to the portfolio tab, so this is basically, as you scroll down, this is the portfolio, so that's fine. As you scroll down, you will see things like, yeah, below that, yeah, there. You will see things like, for example, large cap, mid cap, small cap, right? Now, we have seen that some of our users like to show large cap, mid cap, small cap exposure as a percentage of the total portfolio. And some people like to show it as a percentage of the equity portion only, right? So you can choose whichever option you want on the left hand side. So you can see it's, you know, the other portion becomes huge if you look at the portfolio. So you can choose whichever one you want. And you know, you can just enter the capital, or if you're looking at from the client section, the capital will be automatically entered. And once you've changed the options, you can click the preview button just here, and you will actually see the new options loaded. So once you're happy with this, what you do is you can create the client link. You can, if you, let's say, don't put the text message right now, just turn that off on the left hand side, the checkbox. No, don't close it. Don't close it. Yeah. Just generate a pin. Yeah, right at the bottom, just let this thing come back 1 second. If it's not coming, just close it and try again. Okay, so uncheck that at the bottom. Yeah. And then click on create client link. So once you've done this, create client link. So there you go. So these are all the client link that you have created, as in this is Prajakta's login. So you can actually then, you see the little message icon, you click on that message icon. And if you had wanted to send a text message, it would have gone like this. Is it not showing up on your thing? Just click that thing.
Yes.
Yeah, there it is. Okay. Yeah. So yeah, so even from here, you can send it later on. This will go as a text message. Only reason is with some people who have DND switched on and things like that, they may not receive it. So if you want, you can send it on WhatsApp also. And on WhatsApp, they will click that link, and in 1 second, this mobile phone view will open up. They will have to enter that PIN 8037. So you can test it by sending it to yourself also. Any other questions from anyone? Okay, perfect. So I think we can close out for today.
Yes, sir. Thank you everyone for joining in for the webinar. Do stay tuned for the next week. Same time, we'll meet next Friday, 4 p.m. itself, and we'll come up with a new and exciting topic. So do stay tuned. Thank you so much for joining and have a great weekend ahead. Thank you.